Hello, welcome to our webinar, Planning a Tax Efficient Move to the UK. Thank you for joining us today. My name is Peter Webb. I'm Head of Tax Advisory for the Fry Group. Before we get started, please do bear in mind that you shouldn't take any action on the basis of my presentation today without seeking specific tax advice for your own personal circumstances. And I think it's important to say that I'm only going to be talking about UK tax. So please do have regard to any other tax implications that there may arise in any other relevant jurisdiction for you. So this is our agenda for today. Now, later on, what you're going to be able to do is ask me lots of questions, which I'll do my very best to answer for you. And you can actually pop those questions into the chat box as we go through. So if you have some questions you'd like to ask me, pop them into the chat box, and then we'll do our best to answer as many of those as we can at the end. So I'm going to be asking you some questions too. And the first of the questions that I'm going to ask you is going to pop up onto your screen about now. So when are you planning on moving to the UK? We've got within the next 12 months, between 2 to 5 years, or you're not sure yet. So I can see lots of you are answering. I'll give you a few seconds to actually pop your questions in, and then we'll see how we do. Okay, I think the voting has settled down. So I think we can actually share the results there. Goodness me. So 41% of you are planning to return to the UK within the next 12 months. Another 23% is going to be within 2 to 5 years that you return to the UK. And there's a smaller portion, 36%, you're not actually sure at the moment. Okay, so I think there we go. So you're beginning to plan that return to the UK. There are an awful lot of ducks you need to get into a very neat little row before you move back to the UK. You need to think about these things. When are you actually going to move to the UK? Will your family be returning to the UK ahead of you? And that's quite usual, especially if there are children who need to get into school for perhaps the autumn term or something like that in the UK. The timing of when accommodation becomes available, that can have a huge bearing on the dates you may trigger UK tax residence. You also need to bear in mind the cost of living. There's a cost of living crisis in the UK at the moment, at least according to one national newspaper. Are you returning to the UK for good? If you're returning to the UK for good, you need to plan accordingly. If you're only going to be in the UK maybe for a few years for a work assignment or something, then you have a different plan. So finally, bearing all of those different moving parts in mind, how much tax will you pay? And really importantly, what can you do to reduce that tax liability? So I'm talking about becoming UK tax resident. Why do you care? Why do you care about becoming UK tax resident? Your UK tax resident status determines how much tax you pay in the UK. If you are what we call a not UK tax resident, then, and you've been non-resident for more than 5 years, then generally you're only charged to UK tax on UK sources of income. Your overseas sources of income are not within the charge to UK tax. And when we think about capital gains tax, the tax you pay on gains you make on disposing of things. If you're not UK tax resident, you're continuously not resident for more than 5 years, then generally it's only the disposal of UK land and property that is within the charge to UK capital gains tax for you. As a non-UK tax resident, any overseas income and any any other capital gains apart from land and property are not charged to UK tax. However, when you become UK tax resident and you're what we call a UK domiciled person, we're going to touch on that in a little bit. You're UK resident, you're UK domiciled, you are fully liable to UK tax on your worldwide income and gains as they arise. Whether they're in the UK, whether they're outside of the UK, whether you keep the money outside of the UK or bring the money into the UK, all your worldwide income and gains are charged to UK tax. So you see, your UK tax resident status is incredibly important to you. And your precious non-UK tax resident status, which is reducing your exposure to UK tax, that should be preserved as long as you possibly can. Now, I mentioned being non-UK tax resident for more than 5 years. If you're non-UK tax resident for less than 5 years and you become UK tax resident, that could be really quite tricky. And there are some very special rules that you need to be aware of. And we're going to come back to those tricky rules in a little bit of time. I mentioned domicile. So why does your domicile status matter? So as well as this tax resident status, you have another tax status that is equally important. That is your domicile status. Your tax resident status is assessed each year under the complex statutory residence test. But your domicile status, that's very different. It's assessed over your lifetime. Every one of us has a domicile status at every point in our lives. Generally, you acquire a domicile status from your father's domicile status. And we call this the domicile of origin. That domicile of origin is very hard to shake off. Now, that's the general comment, but with domicile matters can be far more complicated than that. If you're a UK domicile, then your worldwide estate, all of the assets that you own anywhere in the world are within the charge to UK inheritance tax. Now that inheritance tax liability, as a worst case scenario, could be as high as 40% on everything you leave to your beneficiaries above £325,000 when you pass away. So it's a really hefty charge. It's likely to be the biggest tax liability you have hanging over you. So that's a UK domicile. UK domicile, all assets everywhere are within the scope of UK inheritance tax. Now, if you're not UK domiciled, then your exposure to UK inheritance tax is limited to UK assets only. Your overseas assets are not within the charge to UK inheritance tax, and that could be a huge advantage for you. There's another aspect to this. When a UK resident, but not UK domicile person, we look at their tax liability. So you're UK resident, but you're not UK domiciled. They could be taxed on their worldwide income and gains as they arise. But unlike a UK domicile person who has no choice about that, a non-UK domicile can exclude their overseas income and their overseas gains from UK tax when they're UK resident. You need to meet various and quite complicated provisions and conditions for that to work. But it is another tax advantage that a non-UK domicile has. So a non-UK domicile, they have advantages. When it comes to inheritance tax, it's only UK assets. And when they're resident in the UK, they may be able to exclude overseas income and gains from UK tax, provided various complications are complied with. But that non-UK domicile status, which is a big advantage, has a limited shelf life after the move to the UK. The absolute most, that non-UK domicile status is going to last for 15 out of 20 years of UK residence. It could evaporate far more quickly than that if it's clear that that non-UK domicile has chosen to make the UK their permanent home. So we've been exploring the differences between being non-UK resident and UK resident. And what we're now going to do is focus on that really tricky transition between those two tax resident statuses. And at this point, I'm going to ask you another question. And that question is going to pop up on your screens right about now. And that question is, what is your biggest concern about moving to the UK? So the concerns I've listed here for you are rates of tax, weather, and the cost of living. So I'm going to give you a few moments to think about that and pop your answer in for me. Okay, I think the voting stopped now, so, oh goodness me, 3/4 of you, 74%, are worried about rates of tax in the UK. As a tax advisor, I think that concern is very valid. I'm amazed by this one. 6% of you are worried by the weather. Living here in sunny, warm Singapore, going back to the UK recently, came as a bit of a shock. Cost of living, 19% of you are worried about the cost of living. Okay, so we'll stop sharing that one. Okay, so we're thinking about becoming UK tax resident. So a good question, how do you know if you're UK tax resident? So since 6th of April 2013, we have an official statutory residence test. And this is the legislation which is used to decide whether or not you're UK tax resident. The statutory residence test is a 3-part test. And each year, what you need to do is sit down with a test in front of you and you work through those 3 tests in order until your resident status is decided. So the first step, the first test, the first question to ask is, are you automatically non-resident? But if you don't meet the conditions for automatic non-residence, you then have to ask the question, well, if I'm not automatically non-resident, am I automatically UK tax resident? So that's the second question to ask. So you work through the test, do you meet those conditions for automatic UK tax residence? And if you say yes to that, you're UK tax resident. But what if you're not automatically not resident and not automatically resident? Well, in that case, you move on to the third and final part of the statutory residence test, and we call this the sufficient ties test. And under that sufficient ties test, you consider the number of connections you have with the UK. We call these ties. The more ties you have, the less time you can spend in the UK and be non-resident. And conversely, the fewer ties you have, the more time you can spend in the UK and be non-resident. We like the statutory residence test because it gives certainty, and we certainly didn't have that before this test came in. If you stay within the limits, you know you are non-UK tax resident. But maybe you've picked up from my description of the statutory residence test that it is complex, and that's what we don't like about the statutory residence test. It's complex and it has traps for the unwary and the ill-advised. So, under this statutory residence test we've just discussed, you're either resident in the UK for the year or you're non-resident for the UK in the year. And that UK tax year runs from 6th of April to the following 5th of April. So we're in the tax year 6th of April 22 to 5th of April 23. So if you test positive for tax residents in this tax year, you're actually tax resident for the whole of the year. You'll be tax resident from 6th of April 2022. And remember, when you're UK tax resident, and assuming a UK domicile, you pay worldwide income and gains. You pay UK tax on everything you have anywhere in the world as it arises. So if you become UK tax resident in this tax year, maybe you're going to move to the UK in September, for example, what's to stop your overseas salary from 6th of April 22 to maybe September, the date of your move to the UK, from being subject to UK tax? So this is where we come on to one of the more complex areas of the statutory residence test. We call this split year treatment. Split year treatment prevents you from defaulting to becoming UK tax resident from the beginning of the tax year. It preserves that really helpful non-UK tax resident status for longer in the tax year, keeping your overseas earnings, for example, out of the UK tax net for a bit longer. So when you return from overseas, there are likely to be perhaps 5 different possible cases of this special split year treatment that may apply to you. I personally feel that this is perhaps the most complex aspect of UK tax residence. If more than one of these 5 possible cases applies to you, and that is very likely, there are specific ordering rules to decide which case takes priority. Now, rather than dig into the detail of those cases, I think this is probably easiest to illustrate with some real life situations that I've seen over the years. Now, what I've done, these are real life situations, but I've changed the names to protect the innocent. So Duncan. Duncan was living and working in Singapore for many years, and he returned to the UK in 2018. He actually returned in November 2018, and between 6th of April 2018 to November 2018, he did not visit the UK at all. And he earned really well in Singapore between April and November 2018. Now, Duncan's wife and children, they went back to the UK in June 2018, and that was actually to make sure that the children were ready to go to school in Bristol in September time. Now, what happened with Duncan, he hadn't visited the UK at all between April 2018 and November 2018, but he became UK tax resident when his family started to have a home in the UK in June 2018. So why did that matter? What was the implication for that? So Duncan became fully liable to UK tax on his Singapore earnings from June 2018 to November 2018. And this came as a really, really nasty surprise for Duncan. So UK tax rate for Duncan was 45%. Singapore was far, far lower than that. So what had happened with Duncan under these complex split year rules, he had triggered UK tax residence by starting to have a home in the UK well before his physical return to the UK. So this is one of the traps. You can actually become UK tax resident and fully taxable before you physically move to the UK. Another horror story for you. So this is Giles. Now, Giles returned to the UK in December 2017, and he'd worked for a couple of decades in the UAE, in Dubai. But while Giles was living and working in the UAE, his wife and children had continued to live in the UK throughout. They didn't fancy living in the hot weather. So they continued to have a home in the UK. They were based in the UK. They lived in the UK. Now, with Duncan, what happened with him, he had a rental agreement on his apartment in Dubai. And that rental agreement expired at the end of August 2017. Now, rather than renew that rental agreement, which would have meant he'd have to pay 12 months of rent up front, because that's how it works there, he opted to just move out of there and moved into a serviced apartment. Actually, that was in the Fairmont Hotel on the Sheikh Zayed Road, for those of you who are familiar with Dubai. So he lived in this serviced apartment in the Fairmont between August and December 2017. So why was that bad? Well, what happened was that Giles had become UK resident and fully liable to UK tax on his overseas income, his worldwide income and gains, at the end of August 2017, months before he moved to the UK. And why did that happen? When he ceased to have a home overseas at the end of August 2017, there was a date when he started to have his only home in the UK. Moving into a serviced apartment that didn't have the degree of permanence and continuity that would indicate it was a home for him. So he had accidentally become UK tax resident many months before his physical move back to the UK. And the tax rates in Dubai are pretty much zero. So it came as a big shock when he had a tax liability based on his earnings from August to December 2017 in the UK. So given the complexities of split year treatment, if everything is within your control and you can choose the timing of your return to the UK, one of the simpler things you can do is just to make sure you plan to become UK tax resident at the beginning of the tax year, rather than rely on these split year treatment rules. But of course, that's the ideal world when you have complete control over everything. Sometimes the move back to the UK is not your decision, or something that you do have control over. And in which case, the split year treatment provisions can be helpful, but you need to understand the rules. So earlier on, I mentioned these special rules if you've been away from the UK for less than 5 years. So when you return to the UK after a period of what we call temporary non-residence, you may be charged a tax on certain income and gains you received or even brought into the UK while you've been overseas. And that tax charge arises in the year you become UK tax resident once more. So very broadly, if you're a UK resident in 4 out of 7 years before you left the UK, and your period of non-residence is less than 5 years, your time overseas is caught for these temporary non-residence rules. And these rules apply to various bits and pieces. There are certain pension payments, lump sums, for example, that may be caught. There's some very complicated disguised remuneration rules for some strategies to reduce income tax on employment income in the UK. And these payments can be caught by these rules. Distributions from what we call closely controlled companies, small companies controlled by a few people. Sometimes you get a dividend and that can be caught for UK tax. A couple of other things, chargeable event gains on life insurance policies. I think the most common application for these temporary non-residence rules, though, is capital gains. So before you left the UK, you had some shares. You were in the UK for 4 out of 7 years before you left. You go overseas, you're non-resident, you sell the shares at a significant gain, but you become UK tax resident again within 5 years. And that gain that you've made while you were non-resident is then charged to UK capital gains tax in the year of your return. So if you're caught by the temporary non-residence rules, the tax on these payments, as I say, becomes due in the year that tax residence is resumed in the UK. So we've mentioned that you're coming to the UK, and we touched on being UK tax resident, but not UK domiciled. So there is some very specific advice that you would want to take about your circumstances if this is you. So does that non-domicile status have an advantage for you? We've covered this a little bit. Yes, it does on two fronts. So we mentioned that if you're non-UK domiciled, you can exclude your overseas income and overseas gains from UK tax when you are UK tax resident. Whereas a UK domicile, they're fully charged to UK tax on their worldwide income and gains as they arise. Now, for the non-UK domicile to take advantage of this basis of taxation to not tax their overseas income and gains in the UK, there are various conditions that do need to be met. Those overseas income and gains, they have to arise outside of the UK, and they have to stay outside of the UK. There could be some quite significant structuring of bank accounts and investments, for example, to make that happen. And generally, if you use this basis of taxation, you're going to lose your entitlement to tax allowances, maybe your income tax allowance, which exempts £12,570 from being taxed to income tax, or your capital gains exemption, £12,300 of gains that can be made free of tax each year. You lose that. Now, once you've been UK resident for 7 out of 9 years, including part years, if you want to continue to use this special remittance basis of taxation to exclude overseas income and overseas gains from UK tax, you're going to have to pay an eye-watering annual charge, £30,000 a year, and that goes up to £60,000 a little bit later too. If this is you, you're UK tax resident or becoming UK tax resident, but you're not UK domiciled, you can use this remittance basis of taxation to exclude overseas income and overseas gains from UK tax, but you don't have to. You always have the choice. Instead of losing your allowances or paying a £30,000 charge, you can actually just opt to be taxed on your worldwide income and gains as they arise, keep your allowances, and later on not have to pay that charge. And we've mentioned the inheritance tax advantage that a non-UK domicile has. Got a tiny little bit more to say about that in a little bit. I think really this is very complex, and I think the key here is that if you may be non-UK domiciled, the first thing is to understand what your domicile status is, be sure of the position, and then if you are becoming UK tax resident, speak to an appropriately experienced advisor so that you can consider whether it's actually going to be an advantage to you to use this special basis of taxation that allows you to exclude unremitted overseas income and gains from UK tax. Okay, so preparing for that return to the UK. So what are some of those pre-return actions we're going to suggest to you? I'm going to start with employment income. There are a few different things you need to think about with your employment income. And the first one to mention are termination payments, because these are really tricky. If you are UK tax resident at any time in the tax year that you receive a termination payment, become entitled to a termination payment, that payment could be fully taxable in the UK, even though you've been non-resident throughout your time overseas working, and even though that may arise in the non-resident part of a split year. Termination payments are very difficult. Specific advice is needed. Generally, there are two choices that you have to avoid tax on your termination payment. The first one is kind of a nuclear option really, which is to stay non-resident for the entire tax year in which your overseas employment ends or your entitlement to that termination payment becomes due. The other strategy that you have, which may be perhaps a bit more realistic, is that what you need to do is to make sure that the moment that your contract for your overseas employment is fully terminated, it's completely done, and you become entitled to that termination payment. On that date, you need to make sure that you are tax resident in a jurisdiction which has a friendly double taxation agreement with the UK. And that then gives you the possibility of seeking relief under that double taxation agreement to protect a termination payment from UK tax. Moving on, share schemes. If you've been awarded shares from your overseas employment, but those shares won't be released to you until after your return to the UK, there is very likely to be a UK income tax charge on the value of the award that accrues to you after you become UK tax resident. And you're likely to have national insurance contributions to pay in the UK on that portion as well. Now, if that is you, you've got maybe a long-term incentive plan. So you may be awarded shares and you have to hold the shares for 3 years, then the restrictions are released and then you can sell the shares. If that's you and you're going to become UK tax resident before the restrictions on the shares are lifted and they can be sold, then please do speak to a tax advisor, because you do need to understand the UK tax implications for that. And maybe there's some action you can take to protect yourself from UK tax on the share awards. Moving on, a really simple cash bonus. And we see this very often. So we see the scenario where somebody is awarded a bonus for a performance period, maybe a calendar year. And in that calendar year, they were not UK tax resident and didn't undertake any work in the UK at all. And if that's the case, that simple cash bonus for that award period will not be charged to UK tax, even if it's paid out to you after you've become UK tax resident. Moving on to think about your investments. So if you're not caught by the temporary non-residence rules, that there's quite a lot to say. I'm just going to summarize a few points here. Really simple. You've got assets standing at a gain, your investments are standing at a gain. Dispose of those before you become UK tax resident to avoid a future charge to UK capital gains tax. But please do be mindful that if you're selling something and you're resident in another country, understand what the rules are in that country, maybe for taxing gains or taxing disposals. But from a UK perspective, you need to take the gains before you become UK tax resident. So conversely, you've got something that's standing at a loss. Maybe the investments haven't done so well. You've got something that you're standing at a loss on. What you shouldn't do from a UK tax perspective is realise the loss. You shouldn't sell at a loss before you become UK tax resident. Now, why am I saying that? If you sell at a loss before you become UK tax resident, there's no UK tax relief for that loss. If you hold the asset standing at a loss, you sell it only after you become UK tax resident, and that loss will generally be an allowable loss to offset against future capital gains. So quick summary on that: standing at a gain, sell before you become UK tax resident; standing at a loss, only sell after you've become UK tax resident. Final comment here on pensions: you need to consider whether or not you should cash in your overseas pension scheme before your return to the UK. It's very much going to depend on the fund. It's very much going to depend on applicable tax treaties, and there are no hard and fast rules about this. But the one thing not to do is nothing. take some advice now in case there is some action you can take before UK residence is resumed on your overseas pension that may save you a significant amount of UK tax in the future. So take some advice about your overseas pensions before you become UK tax resident. So thinking about investments when you are UK tax resident. So you're going to go through this exercise where you look at your investments, you're going to take out the gains, you're going to keep losses. The other aspect of this exercise is what you've invested in overseas. You haven't had to be mindful of UK tax. You're coming back to the UK, you need to have a tax efficient investment strategy. And that's going to be very individual to you. It's going to depend on your income needs, your domicile status, your retirement objectives. When you're overseas, that investment strategy just doesn't have to be tax focused for the UK. But the UK is a far more confiscatory tax regime than many of the jurisdictions that we see. You need to ensure your investment returns and gains are as free from UK tax as you can make them. On this slide, what I've done here, I've listed some of the UK tax allowances that are available to you on a use it or lose it basis each year. As an absolute minimum, I would suggest you try and ensure your investments are using as many of these allowances as you possibly can between the family each tax year. Just going to mention one, ISAs, individual savings accounts. As non-residents, you can't invest in ISAs. You can continue to hold existing ISAs, but you can't make contributions to ISAs. Now, when you are UK tax resident, you can then contribute to ISAs. So a couple, maybe you've got £40,000 of ISA allowances each year that you can use. ISAs, they can be invested in stocks and shares. You can put £40,000 a year into ISAs, which over a few years really mounts up. Once they're in the ISAs, the dividends, the interest, and the capital gains are not within the charge to UK tax. Here, I'm just going to mention some very special rules for UK land and property. So when you dispose of UK property as a non-resident, and provided you're non-resident for more than 5 years, it's only the gain arising after 5th of April 2015 on UK residential property that is charged to UK capital gains tax. Now, when you are UK resident, that opportunity to rebase to 5th of April 2015 value disappears, and you're going to be charged to UK capital gains tax on the gain arising over the life of your ownership of that property. So if you've owned the property for a long time, there could be a very big advantage to sell your UK property before you become UK tax resident again. And bear in mind, UK capital gains tax on property, you're looking at the highest rates, 18% and 28%. Do note that the disposal of UK property generally needs to be reported to HM Revenue and Customs within 60 days of completion. And within that 60-day window, you also need to calculate and pay the capital gains tax as well. Now, what becomes more complex with this is if you've ever lived in the property as your main family home, then matters are far from straightforward. And it may not give you the best tax outcome to sell while you remain non-UK tax resident. Why am I saying that? Well, the thing is that with main residence relief that applies to the property, you may have an opportunity to get extra main residence relief if perhaps you go on and live in that family home once more, genuinely as a home. So you can get some extra capital gains tax exemptions by doing that. You do need to take a little bit of an exercise, do some number crunching, look at some spreadsheets, just to work out what the best thing to do is if the property you're selling has indeed been your family home at some point. it's time to think about inheritance tax. So I think in my view, inheritance tax is the most punitive weapon in HM Revenue's arsenal. We've touched on the rate. Nightmare, worst case scenario, it can be a tax charge as high as 40% on everything you leave above £325,000. We've mentioned that inheritance tax liability is determined by your domicile status. Quick recap on that, it's not the same as your residence status. And for a UK domicile, doesn't matter if you're non-resident, doesn't matter if you've been non-resident for 30 or 40 years. If you're UK domiciled, then your worldwide estate, all assets you own anywhere in the world, are within the scope of UK inheritance tax. A non-UK domicile, that liability to UK inheritance tax is limited simply to UK assets only. But remember, you're becoming UK tax resident, and if you're not UK domiciled, that starts the clock ticking on that really helpful non-UK domiciled status, which is protecting your overseas assets from UK inheritance tax. So part of the advice process for becoming UK tax resident, what you need to consider are there actions that you could take, perhaps as a non-UK domicile, that would permanently exclude overseas assets from UK inheritance tax, even past the point they have that UK non-domicile has become deemed to be UK domicile because of the amount of time they've lived in the UK or they've chosen the UK as their home country. But those actions are very likely needed to be taken before UK tax residency is triggered. So you do need to consider this before the return to the UK. So you need to talk to an appropriate advisor about that to get the right advice. Okay, last point on this slide. I like simple plans, and one of the simplest ways to reduce your inheritance tax bill is to make lifetime gifts to your intended beneficiaries. So you need to make sure that it's an outright gift, no strings attached, you don't retain a benefit in that gift. Now, if you make those gifts while you remain non-UK tax resident, you may avoid a charge to UK capital gains tax, or if it's a property, you may be able to reduce the charge to UK capital gains tax on the value of the gift. After you become UK tax resident and you want to, for example, give some shares to a child or sell some shares to give money to a child, that disposal of the shares in this example would be charged to UK capital gains tax, whether you gift it or whether you sell it. So if you're thinking that making some gifts during your lifetime could be a good way for inheritance tax planning, then think about that before you become UK tax resident, when you may be able to do that with a reduced charge to UK capital gains tax. Okay, so you've come to the UK, you've become UK tax resident, you need to tell HM Revenue you've returned. But it's actually really quite simple. There's no separate form to complete to tell HM Revenue you've returned to the UK. You just need to make sure they've got your correct correspondence address if that has changed. You do not want to miss something important coming to you from HM Revenue and Customs. So your return to the UK, your UK tax resident status, your claim for split year treatment. How do you tell HM Revenue about that? Well, that's all declared on your annual self-assessment tax return. And I've popped the deadlines for filing that tax return for the current year on the slide there for you. Okay, wrapping up. Well done for bearing with me this far. If you're struggling, please be assured we're almost there. So what we're going to move on to are my key takeaways for today. So make sure that you know the date you're going to become UK tax resident and what actions you need to take before that date. And now is the time to think about reducing your exposure to UK inheritance tax. And don't forget, we've only talked through the UK tax position. Please do have regard to any tax implications and reporting requirements you may have in any other country, maybe the country you're leaving, or indeed any other relevant jurisdiction for you. So thank you. And now what we're going to do is move on and see if we can answer some of those questions that you've asked as we've been going through. Okay. So first question, anonymous, all right. Should I sell my UK property before I become UK tax resident? This is such an interesting question, and there is no, there's not a simple yes or no answer to this. It's very much going to depend on your personal circumstances. If you have a buy-to-let property that you've owned for 20 years, you've never lived in it as a home, and it's got a significant gain on it, if you sell while you remain non-UK tax resident, you could limit the capital gains tax to the gain only arising after 5th of April 2015. If you sell that same property after you become UK tax resident, then it's that gain over the 20 years of ownership that is charged to tax. So you're very likely to get a much better UK tax outcome in that buy-to-let property that you've never lived in if you are to sell as a non-tax resident. But if you've lived in the property as your home, as we've said, it's not quite such a binary choice. You need to do some calculations and work out if that main residence relief that might apply to the property is going to be helpful, and if that could be even enhanced by living in that property once again, genuinely as your main home. Okay, another anonymous question here. I believe I'm not UK domiciled. Is there anything I can do to stop myself becoming UK domiciled? What a great question. All right then. So I think the first thing to say is domicile is not straightforward. Take advice to understand your exact position. Take somebody's views, an appropriate professional. Ask them what your non-UK domicile status is. Get that advice. And if you're genuinely not UK domiciled and it's a non-UK domicile of origin, and that's important, what can you do to stop yourself becoming UK domiciled? If you're going to be a very long-term UK tax resident, you're going to be UK domiciled when you look back and you've been resident for 15 out of the last 20 years, you're UK domiciled. Not much you can do about that. Perhaps you can preserve a non-UK domicile status for longer by making sure you're keeping up your connections with your home country. So perhaps you're born perhaps in Canada, one of the states of Canada. Let's go for Alberta because that's very beautiful. So you have a home in Alberta, Canada. You come to the UK. You're going to become UK domiciled if you are a resident for 15 out of 20 years, or if it's seen that you've chosen the UK as your permanent home. What you can do to protect yourself a little bit from the premise that you might have chosen the UK as your home country is maybe keep up the connections with Alberta. Continue to have a home in Alberta that you use as a home. Keep some possessions there. Read the Calgary Herald newspaper, for example. There are actions that you can take to protect yourself or protect your non-UK domicile status for longer once you've become UK tax resident. I would speak to a professional on that one. Okay, next question. I've made some good gains on cryptocurrency while being only a New Zealand tax resident. Would I have to pay tax on the capital gains when I've moved back to the UK if I sold it there? Cryptocurrency is a very new class of asset. HM Revenue have given some guidance on the rules around this. And what HM Revenue would say is that the cryptocurrency itself is cited where the key holder is tax resident. So if you hold the keys to the wallet that holds the cryptocurrency, it's your resident status, that determines where the cryptocurrency is. Now, if you sell while you remain non-UK tax resident and you're continuously non-resident for more than 5 years, there's no UK capital gains tax to pay on the sale of cryptocurrency. If you sell after you become UK tax resident under HM revenue guidance, doesn't matter whether you're non-UK domiciled or UK domiciled, if you make a gain on it, that gain is going to be charged to UK capital gains tax, no matter if the money stays outside of the UK or if it's brought into the UK. And there can be some very specific circumstances where sometimes the gain is charged to income tax rather than capital gains tax when you're UK tax resident. And that needs some care because income tax rates are 20, 40 and 45%. Capital gains tax rates 10% and 20%. Okay, next question. We touched on this one actually. I have a long-term incentive plan, what we call an LTIP. It's going to pay out over the next 3 years. I will become UK tax resident in that time. Will that long-term incentive plan be taxed in the UK? Yes. There are various different moving parts to this. So what you would do is show the plan to an advisor, and they would likely come up with a schedule for you of what the future tax liabilities will be, just so that you have some warning of those. I'll try and give a very simple example. The long-term incentive plan, you've got 3 years from the award to when the shares are released and sold. You've got 3 years, perhaps you become UK tax resident after year 2. So what that means is 1 of the 3 years you're UK tax resident. So 1/3 of the value of the shares is charged to UK income tax and national insurance contributions when you finally get to sell those shares. 2/3 are not charged to UK income tax and national insurance contributions, but are very likely to be charged to tax in the jurisdiction where you were resident when they were awarded. But those 2/3 which are not charged to UK income tax and national insurance will be charged to UK capital gains tax. So this is all getting very complicated very quickly. There's a lot to consider here, and you do need to speak to an appropriate advisor to get the right answers on this and understand what the numbers would be. Okay, next question, again anonymous. I became UK tax resident during COVID, but wish to be non-tax resident again for a few years. How soon should I become non-tax resident, so as not to reset HM Revenue's tax resident clock? Okay, so it's a difficult one to kind of give a very specific answer on. I think the considerations here are, if you've been non-resident for many years and you've been UK resident maybe for 1 or 2 years, you might want to make sure that you don't trigger the temporary non-residence rules. Those temporary non-residence rules would kick in if you are UK tax resident for 4 out of 7 tax years before you leave the UK, including part years. So you might want to make sure that you leave the UK before you've got 4 out of 7 years of UK residence. And then you can leave the UK, you're not caught for the temporary non-residence rules, and you then have immediate freedom once you're a UK tax resident once you're non-UK tax resident from, for example, the disposal of shares, as a non-resident, not caught for the temporary non-residence rules. You don't then have to be outside of the UK for 5 clear years to be free of UK capital gains tax on share sales as a non-resident. I think you would need to speak to an advisor about that, because there are some very complex rules around how you actually become non-resident and what date will you become non-resident. Why not follow up with us afterwards? We'd be delighted to have a conversation with you, because that is a particularly complicated scenario. Okay, I think we're going back to cryptocurrency. If I have made some good gains on cryptocurrency while being only a New Zealand tax resident, would I have to pay tax on the capital gains when I move back to the UK if I sold it there? I've not been a tax resident for more than 5 years. So sales gains on the disposal of cryptocurrency while you've been non-UK tax resident. So you're continuously non-resident for more than 5 years. You sell your cryptocurrency during that period of non-residence, which extends for more than 5 years, provided it's not seen as anyway trading. Then if it's just a capital gain, that gain would not be charged to UK capital gains tax. I hope that answers the question. I hope I've understood the intent behind that. We have some people who aren't anonymous. Robert. So Robert, I've just moved back to the UK from the Philippines, where I paid tax at 35% for 6 years and I'm retiring. I'm still being paid for outstanding holidays with tax paid in the Philippines. Can this tax be offset against UK tax due? Yes, it can be. So there is a double taxation agreement between the UK and the Philippines. So if you are correctly charged to Philippines tax on something that is also charged to tax in the UK and is income tax in both cases, the Philippines tax can be offset against the corresponding UK tax liability. You can't create a refund in the UK, but you can offset against the UK tax liability. It's quite interesting. It sounds like it's from an employment, so there might be some more specific advice to give around that in terms of would it actually be taxable in the UK for you? Probably yes, but there might be a chance that some of that might not be subject to UK tax. Worth asking the question of somebody. So Simon, I was just looking at the time. I think this might be the last one that we actually get to before we actually wrap up. Does the advice to not sell investments based on gains or losses apply only to assets held in the overseas country? What about assets held in the UK? This is a great question, actually, and it's a good clarification. As a non-UK tax resident, and you've been non-resident continuously for more than 5 years, the liability to UK capital gains tax simply extends to UK land and property, and I guess to be complete, some assets used in a UK trade. UK shares, UK unit trusts that you hold can be sold free of UK capital gains tax. So this advice does not only apply to investments you hold overseas, it applies to those liquid investments that you actually hold in the UK too, but not UK land and property. Special rules for UK land and property. Okay, so apologies if we didn't get to answer your specific question. I'll try to get through as many of those as I can. If we didn't get to your question and you'd like to follow up with us, I'll give you some contact details in a second. So I know that some of you are familiar with the Pride Group, but for those of you who don't know us quite so well, I'm going to just offer a very short introduction. So the Fry Group was established more than 120 years ago. And since then, we've helped thousands of people around the world and across the generations. And today, you'll see on the map, we've got 8 offices around the world, and we feel we offer a global perspective. We have 3 core services, or 3 core areas, and they are tax, of course, where I sit, estates, and investment. And our teams work across those 3 areas together and across countries to create the right balance for each client. So our core purpose is to help people achieve financial freedom. And we understand this means different things to different people. So we take time to find out what is important to you so we can structure your finances around your goals. So here I'm actually giving our contact details. So email addresses, please do contact us if you want to follow up. Please don't hesitate to get in touch. So it just leaves me to say a very big thank you. We've really appreciated your participation in today's webinar. Thank you for those great questions. So thank you.